and they're all cross-collateralized with Bitcoin, right? When, when Luna shot to the sky, they're buying Bitcoin, and when they're crashing, they're selling Bitcoin. So
in this interview, Michael Saylor talked about several new support and resistance levels for Bitcoin. He talked about the Fibonacci retracement levels, compared the current market to that of 2020, and gave his new predictions for Bitcoin. Also, I'd just like to remind you that we're giving away $100 to a random subscriber at the end of this month. To take part in it, all you have to do is subscribe to our channel, turn on post notifications, like this video, and leave a comment in the comments section below. Good luck. Now, let's look at his interview.
I think if you look at the near term, Bitcoin looks like a volatile risk asset in the near term. And if your time frame is near term, if it's a high frequency time frame, then you kind of got to trade Bitcoin like a high volatility risk asset, or an amped up risk asset. And if you're a low frequency long-term trader, if you're buying it with expectation that a decade from now it'll be worth more, now it starts to look like a store of value non-risk asset, because there's no management team, there's no product cycle, there's no employee base, there's no competitors, it's not a company, it's got no nexus, it's not in a country, it's not land, you can't produce more of it, it's a different thing. So depending upon whether or not you're short time frame or long time frame, you see it differently. And I think that in the near term, it's pretty clear it's a risk asset, and the Federal Reserve is going to control all the risk assets. And so when they squeeze the money supply, all those assets, the tech equities, the Bitcoin, they get hammered down. To your point, it seems reasonable at some point they'll lighten up. We're going into the midterms, right? So the things that are constraining risk assets right now are the war, foreign relations, and the war in Ukraine, and the Russian foreign policy, and the monetary policy, and those could very well change. If they don't change, then all the risk assets will have a hard going for the next year to 2 years. Yeah, and if they lighten up, then there'll be a rally, to your point. There's a macro trend going on, and the macro trend is the demonetization of equities as some of that monetary premium flows into Bitcoin, and the demonetization of gold as some of the gold's monetary premium flows into Bitcoin, and the demonetization of bonds, and the demonetization of investment, second home investment, real estate. So all of those things are store of value. They've been monetized. It's simple to prove they've been monetized. You can, by just checking their correlation with the Fed balance sheet, and as the Fed expands, and their asset prices increase. And so the difference between today and 2008 and 2000 and 1990 whatever two and 1974 is, in 1974 you had this massive macroeconomic chaos, and we monetized gold, and gold went from $34 an ounce to $800 an ounce. Right. And that was the safe haven, and we kind of you could argue we monetized crude oil, right? The petrodollar, and there was a big adjustment. This is the first time where we've had the potential to monetize a digital scarcity, which is what Bitcoin is. So it's still too early to say that that's a mainstream thing. It was not an institutional grade asset at all at the beginning of 2020. MicroStrategy was the first public company to make any material commitment to it. That's August 10th, 2020. But if I make a list of all the things that cause Bitcoin to trade down, right? If I make a list of the parade of horribles, right? Let me name my pain. And they're all going to reasonably reverse in the next decade. But here's what they are. One, wash trading. You can wash trade crypto and you can wash trade Bitcoin, and there are no wash trading rules. This is volatility inducing. This is not good, because it means that if you trade down 10%, you're probably going to trade down another 10%, because people are going to, a trader is going to say, I'm going to sell it at a 10% loss and buy it back at a 20% discount and ride it up again. So wash trading is an immature affectation of the asset class. You shouldn't be able to do it. It could be fixed by Congress and the House Ways and Means Committee. When the IRS or somebody fixes it, then the asset will be less volatile. The crypto exchanges, offshore and onshore right now, are unregistered, unregulated, and they offer 20x leverage. They don't have mature Chinese walls separating their market makers. You know, sometimes they make a market. In some cases, they own some of these tokens. They unilaterally decide when to list them. There's information leakage. And if you had 20x leverage trading on Apple stock with no wash trading rules, Apple would be a lot more volatile asset. And so with the NASDAQ. So the unregulated crypto exchanges are liability number two. The third is the crypto tokens, 19,000 unregistered securities. Okay, like I have one that's a commodity. If you look at the next 25 by market cap, they're all securities. Okay. In fact, you might be able to find 6 things or 12 things out of 19,000 that can make a straightforward legal argument as being without an issuer and therefore a commodity. But what you have is a $400 billion cloud of opaque, unregistered securities trading without full and fair disclosure, right? And they're all cross-collateralized with Bitcoin. Right. When Luna shot to the sky, they're buying Bitcoin, and when they're crashing, they're selling Bitcoin. So if you look at ETH and you look at all the other crypto tokens, they tend to trade with a high correlation to Bitcoin, because on Saturday afternoon, you're pledging Bitcoin as collateral against your Solana margin loan as it crashes, and you're getting a margin call. So I think the story was like, and that takes me into my number 4 point, crypto hedge funds, or what we'll call the wildcat banks. Luna was one, but Celsius, and, you know, there's a whole list, right? 3 Arrows is crashing today, I guess. Well, in some cases, right, you take 2 million people's deposits and then you bet it in a DeFi protocol. Okay, so they're unregulated banks, they're unregistered investment companies, they're trading unregistered securities.
And a lot of
with 20x leverage.
And a lot of people are getting hurt. Absolutely.
Including Bitcoin, right? I mean, it's a liability to Bitcoin, right? You have wildcat banks that are wiping out. Okay. Then the 5th liability is ignorance. Just a lot of people, they go, every time someone criticizes crypto, I go, well, if you use crypto and Bitcoin interchangeably, that means you don't know what crypto is. And that means you don't know what Bitcoin is either. Right. So it's a meaningless phrase.
I get that a
right?
lot. Yeah.
Like Bitcoin is exactly the diametrically opposed opposite of just about everything else in the crypto space, right? The fact that they're actually conjoined is one of nature's great ironies. Okay, so.
But that's where then regulation actually becomes a favor, positive for Bitcoin.
That's true. And the lack of regulation has allowed all of the wildcat crypto hedge funds to have a meaningful impact on the price of Bitcoin. Right. And if they actually regulate them and they take out those crypto hedge funds so that they can, and the crypto exchanges, so they can't exercise undue influence over the price of Bitcoin, it would do a lot of things. It would immediately decrease the volatility. But there are a lot of mainstream banks, mainstream insurance companies, mainstream market makers, mainstream investors that won't invest in the asset class because of the slime that gets onto the asset class from all the other unregistered securities, which have created a very bad reputation for all of us. So the other things are the lack of a stable coin. And by that, I mean, right, UST wasn't a stable coin, and Tether is an unregistered security without any transparency, right? And so there's never ending Tether FUD, never ending. It will never stop, right? Are they solvent? Will they be solvent? The closest thing to a stable coin is maybe Circle or the Paxos offerings, right? Because there's some clarity. But, you know, if the SEC said, okay, you have to file your assets at the end of every day, like that's what they do with an ETF or an ETP, right? Like if you're ARK investment or you're something, you're actually publishing what you're holding.
Right.
So if there was clear high frequency transparency and they said, you have to hold this mixture of assets and you have to publish every week or every day, you would have a stable coin. And then of course, all the money that was sitting in the quasi stable coins would probably migrate to the stable coin. The overall stable coin balance would increase, but you know, there was a point when there was like $18 billion of UST quote unquote stable coin holding, and that went from 18 billion to 0. Right. So if we have a reliable, regulated stable coin, that would be good for the industry. That would decrease volatility. That would increase credibility.